Debt market update. GSEC yields moderated during the month, with 10Y GSEC yield ending at 7.08%, 6 BPS lower compared to end January 2024. The yield at the short end also moderated, driven by proactive liquidity management by the RBI. The key factors and events which influenced the fixed income markets included lower than expected fiscal deficit for FY25, consistent buying of GSECs by FIIs, status quo of monetary policy by RBI, a benign domestic CPI, robust US CPI, and rise in US yields. 10-year corporate bond spreads over GSEC narrowed further during the month on back of underwhelming supply and strong demand. Average interbank liquidity deficit declined slightly month-on-month, driven by rise in government spending. RBI proactively announced VRR and VRRR operations, which kept the overnight rate within the RBI's policy corridor. FPIs bought, including voluntary retention route, debt worth USD 2.8 billion in February 2024. Cumulatively, FPIs have bought debt worth USD 12.3 billion in 11 MFY 24. Outlook. The outlook for fixed income remains favorable over the medium term in view of the following key drivers. The lower than expected budget deficit and market borrowings are a significant positive because of improved demand-supply balance, as demand is likely to remain robust in FY25 due to India's inclusion in the JP Morgan Bond Index. Further, recently announced inclusion of India in Bloomberg's EM Bond Index also likely to aid demand resilience. Core CPI momentum remains subdued, driven by lower input price pressure and benign global commodity prices. Further, headline CPI is likely to ease and inflation expectations also remain well anchored. Major global central banks, especially the US Fed, have indicated the end of the rate hiking cycle and are likely to start easing in due course. RBI is also expected to eventually reduce the policy rate in the coming quarters. India's external sector vulnerability remains low due to high foreign exchange reserves, range-bound oil prices, robust services exports, and the likelihood of FPI inflows into the debt markets in FY25. However, there are following risks to the favorable outlook. SLR holdings of the banking system are high and credit growth is robust. With interbank liquidity in deficit, the incremental demand for GSECs is likely to remain muted. RBI's policy rate can remain higher than expected due to multiple reasons, including food price shocks keeping headline CPI elevated, rise in commodity prices due to escalation in geopolitical crisis, monetary policy globally remaining tight for a period longer than expected, among others. Overall, in our view, yields are likely to trade with a downward bias, and the long end of the yield curve is likely to outperform over the medium term. Thus, as highlighted in past, for investors with a relatively longer investment horizon, it is a good time to increase allocation to longer duration funds in line with individual risk appetite. Further, given a flat yield curve and elevated short-term rates along with expectations of rate cuts in the coming year, one may also consider investment in short to medium duration debt funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.